All right, so in this video, we're going to talk about LIFO liquidation, or just more generally liquidating layers. And when we're talking about layers, we're really just talking about inventory purchased at a price point. So we buy inventory from our vendors at a certain price. And basically, every purchase of inventory we make can create a new layer because there will be different price points of inventory. Now, the layers are how we understand what to sell off when we're applying LIFO and FIFO, cost of goods sold. Right? We got to make assumptions about, well, which units are we actually selling? And many times that turns into a visualization of our inventory consisting in these sort of layered pieces. So let's look at this example. On January 20th, we purchased 400 units at $4. So over on the side, I'm going to represent first the purchase, or basically what our gaffs would be given the purchase. And, assuming that January 20x2 is the start of the company, we have no former inventory, then they're going to make this purchase, and all of this inventory that they purchase, which is 400 units, is their goods available for sale. They sell 250 units, and so I'll put our cost of goods sold here. Now, because we only have one layer of units, the cost of goods sold method that we apply does not matter. They're all last in, first out. They're all first in, first out because they're all at the same layer. They're all at the same price point. So we're just going to have 250 of these sold. And if we're applying LIFO, then kind of the ones at the top, right? You'll see it matters a little bit more when we do multiple layers at the same time. But then we sell 250 of these, and they're sold, not 250, but 250 units of these, not dollars, at $4. And then this final layer over here, the one that's already printed for you, is the ending inventory for each. So after we sell 250, we only have 150 remaining at $4, and that translates to an ending inventory of 600. All right. But then suppose we buy 600 units in the next month and we sell only 375. So now this is what our ending inventory. That means it's going to be our beginning inventory at the start of the next period. So in my ending inventory, I had 150 units at $4. But then I purchased 600, so my goods available for sale would be my beginning inventory and my purchases. And then I sell 375. So now we're going to have a difference in my cost of goods sold between LIFO and FIFO because LIFO is going to pull from these most recent units at the top. It'll pull more than half of that because it pulled 375, and that'll be my LIFO cost of goods sold. I'll come back and talk a little bit about FIFO and why this liquidation of layers is not an issue for FIFO. So we're always stripping a little bit off, 375 from this layer, and then that leaves us with 225 at $5. This is again my ending inventory. Notice my 150 flows over because they were older purchases and I didn't sell through my purchases this period. I only sold 375 of them. And since I didn't sell through them all, another layer enters into my ending inventory. Well, let's say this trend continues, right? I buy units every new month, but I don't sell through the purchase that I made during that month with my sales during that month. So always there's a new layer of inventory being formed here, right? And that can be problematic if suddenly you have sales that outstrip your purchases during a period. So this would be my ending inventory at the end of May. Then suddenly, let's say in June, our seasonal demand kicks up and we have 800 units that are purchased. We purchase each at $9. If you notice, there's been a steady increase in our inventory costs over time. So now our gaffs would consist of all these layers as our beginning inventory. And the additional layer that I purchased here. So I purchased 800 at $9 a unit and I sold through 975. So all of this layer is gone. We'd have to go back to the next most recent purchases under LIFO. The 50 at 8 would be the next ones to go, but they all get eaten up, right? I still need 125. The next layer is 100 at 7. That one gets eaten through. Altogether, that's 950 units. I need an extra 25 units. Well, then the March layer is 75, and I'm going to use 25 of those. So maybe like a third of the way down. Then all of that becomes my cost of goods sold. Now, what is problematic about this is that LIFO is based on the idea that if my most current inventory costs are the highest, this is what produces lower cost of goods sold. So as we apply LIFO principally because LIFO during rising prices or rising inventory costs increases my cost of goods sold, which reduces my gross profit, cost sales minus cost of goods sold. And that reduction in gross profit, all things equal, all if all of my operating expenses are controlled for and set, that reduction in gross profit kicks up a reduction in my pre-tax income. And so the entire idea behind LIFO really is to match your sales against higher price points. But if we liquidate layers and our sales outstrip purchases, then we start dipping back into older price points. And the fact that we're going to do this will actually reduce our cost of goods sold that we would if we had not sold through an entire layer. So here in this case, it would be the 800 at 9. We'd add, so that's 7,200. This would be 400, 7,600, 8,300, and 8,750, I believe, in my cost of goods sold. Oops, I'm sorry, that should be 8,450. My first calculation sold all 75, but only 25 of those were sold, right? So we would have 8,450 as our cost of goods sold. And that's still relatively high because as we burn through the layers, yes, we do burn through them if we're using LIFO in the order of the most recent purchases, which if inventory costs are rising, they're still relatively high prices compared to some of our ending inventory. But it's not as high as a cost of goods sold as if we had purchased them all at the current price for the period. All right, so we're going to take that and we're going to apply it into how we would showcase these inventory profits. Now, remember, inventory profits are any discrepancy between what cost of goods sold was given the cost flow assumption and what that cost of goods sold would be if we priced every unit at its current cost to replace. So how much would we have to spend to reorder that inventory from our vendor per unit? So the problem with LIFO liquidation is that the June sales are being matched with those cost of goods sold from the prior periods, May and April. And like I mentioned, that increases our gross profit because old price points that are lower costs are being used in cost of goods sold rather than all current costs. And this increases tax expense, which is unavoidable because of the LIFO conformity rule that says basically when we use LIFO for our taxes, then we have to also use it for our financial reporting. So when this effect becomes material, the company has to disclose the effect of the LIFO liquidation in the footnotes and reveal the amount of inventory profits for the period. So in this example, we have to look at we were matching the old prices against current sales. But if we're calculating inventory profits, then we'd want to match them against the most current price. So in this case, we'll take that $9 as my current replacement cost because that was the amount that we paid during the month when most current month, right? Versus what it was actually recorded at under the cost flow method, which is those 800 units that we purchased, the 50 in the layer prior to that in May, the 100 in the layer of April, and then 25 in the layer of March. And this actually should be 8450. I checked that again just to be sure. But yeah, so that would be $8,450 of cost of goods sold. And so the difference between if I had bought them all at the current replacement cost, which is $9 in this example, of 8,775 versus this amount of 8,450 is our pre-tax inventory profit. So this is a profit that is not real. It only arises because we are making an accounting assumption about the flow of goods, and it's recast against, well, what gross profit would we get from this sale if we had to buy that product today at today's prices and then sell it at today's prices? That's the 8,775 versus the amount that we recognize through our LIFO. And then in order to show what its net of tax effect would be, if we have a 40% tax rate, then just multiply it by 1 minus that tax rate, and you'll get the net amount after tax that it increased my inventory profit by. And that's really the end of the LIFO liquidation piece. Understand that inventory profits can be calculated with any cost flow method. And again, it's just then substituting instead of the LIFO calculation, the FIFO calculation of cost of goods sold and comparing it against what the what the current replacement cost of these units at their most recent price would be. And under FIFO, that's going to kick up a much higher inventory profit. Great. So the next videos will go into the lower of cost or market or lower of cost or net realizable value adjustment.